Hey everyone, this is Mike Mentor, Chief Investment Officer with Financial Synergies. And this is your Market in Minutes report. And we are looking back on the first week of the new year, 2024. Hope you guys had a wonderful Christmas break and are having a happy new year so far. So let's jump right into what occurred last week in the market. And although we had a nice run up to the end of the year, which was really a phenomenal run through the end of 23, unfortunately, the first week for the markets was not so great. So, which, look, when you've had a great run up like that, it's not unusual to have a pullback. Especially, sometimes January does start off a little rough, depending on the environment. And of course, we've still got a little bit of a hangover from the Fed stuff and rates and inflation and all of those things, which are still obviously very, very relevant. So 5-day performance, not great, but nothing to be too concerned about. Obviously, small caps got dinged up pretty hard, but they had been the highest flyer over the last month. I mean, these things just popped, I think, over 15, 16% just in the last month or so of the year. So it was a stellar run for small caps. So it's not unusual to see a little bit of a pullback. Same thing with growth stocks, tech stocks. Nasdaq pulled back pretty good. Really the Dow Jones was just a pretty nominal pullback last week, but some of the higher flyers took a knock there. So down to start the year, nothing to be too concerned about. Year-to-date performance is exactly the same. Obviously, we don't have any other data at this point, so 5-day and year-to-date is the same numbers. As I sit here today, the market actually closed up really nicely, so these numbers have improved dramatically. I just don't have the updated numbers yet, but today was a good close for whatever that's worth. Let's take a look at rates. So these actually we did start to see rates tick back up last week, and that was part of the reason in the decline in the equity markets is rates did start to increase a little bit, whereas they had been on a steady downward trend in the fourth quarter. So we'll talk a little bit more about that. Again, nothing to be alarmed about, but you did see the 30-year Treasury tick back up over 4%. The 10-year is now at 4, and 2 years 4 and some change. 30-year mortgage did tick back up just a little bit to 7.22. Still down considerably from its high, but that's kind of where we stand on performance and rates. So let's talk a little bit about the story behind what we're kind of seeing here is the New Year blues. So stocks got obviously off. And one thing I've learned about very quickly in investing is that the markets don't care about calendar years. So just because we flip the page on a calendar year does not mean that the market forgot about everything affecting the markets and the economy. And so those things don't go away. You just turn the calendar page and they're still there. So very much some of the same factors. But we are moving past, I think, what a lot, where we were really in the thick of a lot of problems last year. I think we're kind of seeing light at the end of the tunnel. So stocks got off to a rough week. Tech names leading the week's decline. Obviously, tech got hit pretty hard, and small cap. Several market observers, they're calling this kind of the reverse Goldilocks effect last week, where market decided investors were getting a little too excited over the possibility of Fed rate cuts. Yeah, maybe that's the case, but it's also likely that it was just time to take a little money off the table, profit taking and those types of things, generally speaking, when you have such a strong run up. So stocks bounced up and down each of the 4 trading days, but ended each day down except Friday, which was actually a bright spot, when the Dow, Nasdaq, and S&P all ended the day in the green, when jobs data helped soften the week's slide. So let's jump into a little bit more of the economic factors here. So as I said in the previous slide, kind of deja vu, right? The Fed and jobs. Just because the calendar year changes doesn't mean these things go away. There will be certainly other factors that impact the market this year, for sure, as there always are. Some surprises, of course. But there's, at the end of the day, we're still going to be dealing with the Fed, inflation, rates, the jobs. That's going to, for the foreseeable future, that's probably the narrative. And so we'll continue to monitor that. But the other side of that is that it's getting better and better and better. So Wednesday, manufacturing news came in better than expected, and that lifted markets until the December Fed meeting minutes were released. So it was kind of up and then down. And that revealed that the Fed members had discussed rate cuts for 24, but no specific terms. So I think the market was looking for a little bit more concrete guidance from the Fed as to when those rate cuts might come, or that they were 100%. Didn't really get that, so kind of a little bit of a disappointment there. Jobs and services sector news painted a better picture of the economy on Thursday, but the 10-year Treasury hit 4%, and that, stock prices responded negatively. So that's what we were talking about on the first page. So the rates have ticked up a bit, and they saw that 4% barrier, and the market didn't like it. Finally, employment data helped buffer the week on Friday as employers added 216,000 new jobs in December, and that bested the estimates, surpassing the 173,000 added in November. That kind of bested economists' predictions. So unemployment remaining steady at 3.7% also helped sentiment, which is part of the reason you saw the markets rise on Friday. So that rounds out kind of the main stories. So what's on deck for this week? So Tuesday we have international trade in goods. This is key economic data, international trade in goods. Wednesday, EIA petroleum status report. Thursday's a big one. Jobless claims, the CPI, and Treasury statements. So we'll be watching that closely. Friday also pretty big. Producer price index, not as big as CPI, but still something to keep an eye on. Companies reporting earnings. It's a pretty big week, actually, for earnings. Jefferies on Monday, Albertsons on Tuesday. Wednesday, we got KB Home, Rite Aid Corporation, and Thursday, Infosys. And Friday, United Health, JP Morgan Chase, big one, Bank of America, Wells Fargo. So big financials on Friday. So that'll be worth keeping an eye on. So that pretty much wraps up last week and then kind of what's on deck. I'm going to be putting out, this is a very quick kind of just summary of last week, the first week of the year, my first video of the year. So thanks for letting me get through that. Now, I will have a lot more detail on all of last year, kind of a full market review, and also some topics for discussion for 2024. Always fun to just get the lay of the land and see what stories may be developing for the new year, but also kind of a more in-depth look of last year. So I'm working on compiling all that, so we'll have a really comprehensive market review. We'll have that in print and video, a blog, all the work. So stay tuned for that, and more to come. But other than that, I will follow up with you guys on everything we just talked about. And if you would like to contact us, by all means, please. We're always here for you. And subscribe to our YouTube. Hit that little subscribe button below. We're always looking for subscribers that are interested in this type of content. It'll keep you up to speed on the markets and the economy. So, okay, guys, I appreciate you letting me get through that in the new year. Here's all your disclosure data, and we'll be talking to you soon. Thanks, guys.